My name is Marko Miušković. I'm a senior partner at Wealth Strategy Partners. I'm glad to see you all making this morning 7:30 our event. This is our second business exit planning event for this year. We usually throw two of these events, one in the beginning of the year, one towards the end of the year. This event is a fourth year that we're throwing these events. The people in the panel, I'm going to introduce them. We came out with the idea to form this panel like 2014 with the idea to help business owner kind of realize what does it take from all the aspects of planning, what does it take to prepare the business for successful exit. In 2014 was the first time when we have an event like this, when we put four of us in the room and try to answer all of your questions in one spot, so you do not need to go to different places to ask different questions and get a different answer. So we have everything at once right here in this room. Business exit planning is very important because a lot of business owners, when they start their career as a business owner, they do not think about how they're going to exit. Unfortunately, they usually think about that event when it's too late, or they're kind of like right there, burned out, with no energy. They just want to get out. So we see those scenarios numerous times through our number of years of experience. I'm going to go, and before you guys start asking questions, I'm going to moderate it. We have a preset questions that we're going to ask just to help you understand a little bit better. Each of our panelists will answer in respect to their field. I'm going to introduce Ethan Lee. He's a business valuator. He's associated with Cooper Norman. He's a partner with Cooper Norman and also associated with Pacific Business Valuation LLC right here in Honolulu. Ethan has specialized in business valuation and litigation support services since 2006. He's a certified public account CPA, licensed in California, and holds the accredited in business valuation ABV and certified in financial forensics CFF credential through the American Institute of CPAs. Ethan is just a wealth of knowledge when it comes to the business valuation, so please think about the questions that you can ask Ethan through our workshop today. Charles Au, CPA, great friend and a great partner in this business exit planning advisory board. Charles is one of the partners in ECA LLP. Charles' company has like 18 people, and we work closely with Charles' office when it comes to the business exit planning. Just a wealth of knowledge when it comes to the tax planning, business planning. So think about it, questions that you can ask Charles while you're here. Scott Settle, attorney at Settlemeyer Law, LLC. Scott is the managing principal. Also wealth of knowledge. We've been working for quite a few years now. Scott has a team of attorneys that help pretty much on every single case that we are working on right now when it comes to the business exit planning. They are ultimately the last stop before the execution when it comes to the drafting agreements, drafting documents, making sure that we look at these business exit plans from all the aspects. When we look at the transfers, we make sure that everything is looked and think through. And Scott, Charles, and the rest of the team from Scott's office are pretty helpful in that whole process. Myself, maybe Charles want to introduce me. I'm going to put him on the spot so I don't brag about me.
I can't do a good job as Marko can about talking about Marko, but Marko, he's one of the founding, actually he says he's one of the senior partners, but he's actually was there from the beginning. He built his business around helping business owners. Hawaii, that's very centric, because we are driven by small business owners, so I think that's great. He's originally from Serbia, came here, went to college and made a life here. Has two beautiful children. He's a great father. He is a great friend to all of us here. We appreciate him so much, and he's a bit shy, so please be sure to ask him some questions as well.
Yeah, thank you, Charles. I'm far away from being shy, but someone needs to be forward-thinking. Anyway, so we're going to start. We have a preset questions like I mentioned earlier, but I'm encouraging you through the process. Just ask questions as you go. As you see something that is applicable to your own business, just ask questions, because we want to make sure that you leave today's event just better equipped with knowledge getting the idea of what does it take to go through the business exit planning process, what are the components, what are the steps, so on and so forth. So I'm gonna start with Ethan, because most of the time when we are going through this process, one of the first questions we ask the business owner is like, what are you transferring? Do you know what you're transferring? What are you selling? What is the value of your business? Are you selling a business, or are you selling a job? Because if you think about it, if you're making a couple $100,000 a year, that's your net profit. You maybe have a job, not really a business. So that's one of the first questions that we ask the business owner. So one of the steps early in the beginning is the business valuation. So Ethan, why would the business owner need the business valuation?
I think one of the biggest reasons is that when you meet with Marco initially, you come in, and I think one of the first steps in the process is to figure out what the whole pie looks like in terms of your net worth and your the value of your assets. As you plan for an exit, or especially if it's leading into retirement, you need to know, okay, how much am I worth? And people typically have a really good knowledge of how much money they have in the bank account, how much they have in terms of maybe securities in either in a retirement account or a brokerage account. They have a pretty good feel for what their house is worth. But there's a big question mark on what the business is worth. They might have an idea, heard of different rules of thumb, but really at the end of the day, they don't have a good idea of what it's worth. And so I think that's one of the biggest reasons why it's helpful in the beginning especially. You can get an understanding of what it's worth, and then is that enough? If not, how do we make it more valuable?
I will add to it a lot of time, because you don't know really what is the value of your business. When the valuation comes back, that can be the determining factor when you can get out of the business. If the valuation is high enough to satisfy your lifestyle going forward, and the money that you're going to receive from the sale after tax is enough to maintain the lifestyle, maybe you can get out sooner. Unfortunately, I'll say 80% of the time the valuation is not there, so you need to work a little bit more just to get the valuation up and running. Charles, a lot of times people don't realize when you're selling the business, there is three parties, right? There is a buyer, there is a seller, and there is one more party that is really sitting on the sideline, and they really don't care how much you sell it for and what are you doing, how you do it. They just want a piece of it. Can you tell us a little bit about that third party and why it's important to plan ahead of time?
I see a nod.
Well, yes.
Who's our partner? Who's our silent partner? We got two, right? That's the IRS, right? IRS in the state of Hawaii. They get their pound of flesh. No matter what you sell it for, no matter how hard you worked at it, they took some money as you earned it and built it, and they're going to take some money as they leave it. They need to, or they want to. So we know that in the traditional setting, when you buy and sell something, you sell it you sell the stock or you sell the assets, whatever. In a traditional sale transaction like that, the overall taxes is somewhere around 75%. The government gets about 75% of the deal. And here's how it works: you sell it for $2 million, and you pay capital gains rate. But in fact, there's AMT, so that's 26%. State of Hawaii is 7.25. That's 33%, 33.25%. But what does the buyer have to do? He has to earn $3 million, right? $3.5 million. Pay ordinary income tax on it, 40% on that, right? 1.2 million on it, just to get you your $2 million. So 3.5 to get the 2 to give it to you. That's 1.5 million. Then you turn around and pay 30% on that 2 million. That's another 2.1 million on a. I'm sorry, I got the number wrong. It's almost 100%, right? It runs that way, right? It's big money all around. So we know that in a traditional setting, when you're just going ahead and say, hey, let's get some docs together, I'm just going to give it to you for this amount of money. Iris is just saying, that's great, please do. At any price, it's going to work out. So our hope is that when we get involved in it, once we understand the nature of it, what it might be worth, you turn around and use some of the more advanced planning opportunities that you have to transition into the business in a less traditional way. And the team that we've assembled here understands the nuances, understands the changes we want to make in structuring a deal. It doesn't work in every case. All of your businesses are different, all of your circumstances are different, so there will be some modifications to it. but we're prepared to help you to deal with that. It's interesting, Marco said about value, right? We all know what it's worth. It's worth a lot. Right? It's a lot. Right? All based on scale, it's going to be a lot. The answer, though, is more important than what you believe it to be worth, is to understand what you need it to be worth. Right? Right? You know, it's what do you need when you go to retirement? What is it that what is your burn rate going to be at retirement? It's going to be more, right? Because you're not going to put your car, you're not going to put your cell phone and all that through the business, right? You're going to pay that yourself. Also, it's a personal expense. What are you going to do with your free time? You're not sitting around, right? Your spouse, your husband, your wife. I've been waiting around for a long time. Now let's go. Packing stuff, kids are on the man and all like that. Your burn rate actually goes up. So understanding what you're going to need at the end, and understanding what you need to have as your nest egg, super important. How many of you have done that? There's a half. I'm going to give you half a credit for that. Mr. Hicks? Yeah, there's a half. Okay, between the 18, yeah, we got one, a combined one. But so as we go through the process, even as we go through the technical process, there's so much that needs to get done on your personal side. So it involves you, involves your spouse and your family and all like that.
Can you back
Yes.
up on that one? Tell
Sure.
us, you kind of moved a little fast.
Yeah, I
and
do speak a
didn't
lot.
really-
I
Okay,
talk
so,
quickly, yeah.
so if I want $1 million, after everybody's paid off, I want $1 million. That's what's gonna support my lifestyle net. That's what I want in my account. How much do I need to sell for?
Yeah, good. Yeah. 1 million divided. Perfect. That's
the question.
Yep. 1 million divided by about 0.7. Yeah.
1.7 million.
Yeah. No, so about $1.5 million, right? So it's $1.5 million. You'll pay a third to taxes, which is about almost 450.
Capital
And-
gains, right?
Right. But it is technically, but at the way the rates work, at $1 million of income plus whatever you've been making during that year of sale, your tax rate is actually 26 AMT and 7 1/4 for states, so it's a third. So sell it for $1.5 million, pay $450 to the government, Fed and state combined, and you'll get $1,050,000. Yeah.
Perfect. Let's talk about the legal documents for a moment. A lot of times before we even get to the point that we're transitioning out of the business and you're selling the business and you're talking to the buyer or seller, what kind of documents you need to have on the end of the days and what are the terms of that agreement. Businesses need to have a certain set of documents regardless. So when it comes to the legal documents, Scott, why don't you tell us a little bit, what should every business have on their shelf when it comes to the legal documents?
Okay, yeah, it's real important when you go to a sales transaction, the buyer's gonna come in and they're gonna have an attorney or they're gonna have an accountant that says, hey, we need to see all your documents, and you're, well, what is that? So organizational documents, obviously, if you're a corporation, your articles of incorporation, your bylaws, and your meeting minutes. Or if you're an LLC, you have articles of organization, you have an operating agreement, and you may have some meeting minutes. Those kind of documents that show that you are, in fact, an actual legal entity. And if you're not, then you're not, but I mean, typically people are looking for that type of document. Those type of documents, and that they're updated and that you have been following the minimum amount of formalities in running your business so that there's you know, the limited liability aspects of the company are protected. I think there's other stuff as well though, and it really depends on what your business is and involves, but typically you have a place of work, so you're gonna have a lease, right? And so sometimes some business owners, they own the property and then they charge a lease rent or something. They don't have an actual lease, but a buyer is going to want to see a lease for the space. Otherwise, they're going to assume that when they buy the business, they get the building. And if you own the building and you wanted to sell the business, but you wanted to keep the building, you got to have this lease in place. And so that's important. And then if you're a service business and your revenue is based off of contracts and you know, doing work for folks, having documented evidence of what those contracts are, so you can prove that these are contracts that are long-term, they're going to last for so many years, and you get this expected source of revenue coming in, or you can show a pattern of that. Obviously, you need to have your tax returns and your financial statements done, and a lot of times, you know, a lot of small businesses, Um, you know, my wife runs one as well, just scrambling every year in October for the prior year to get all their books and records together to have it so they can give it to their CPA. I mean, when you go to sell, you gotta have your stuff together so that you can hand over a neat package of stuff with tax returns, leases, contracts, all your order docs, so that you look professional, you look like you're well run, so that the buyer feels comfortable that what you say is true because you documented it. And also, when you go to somebody like Ethan, or the buyer goes to somebody like Ethan and says, what's this thing worth? He's gonna do some interviewing and talk story with the owners, but a lot of it's gonna be based on what's documented. And so if you don't have documentation, your value is gonna drop because people are just gonna have to trust and hope that you're right in what you're telling them.
Thank you. When we start doing this, like late 2013, 2014, I did quite a few workshops that I participated myself, that I actually went to listen and learn from the other advisors. And one thing that I realized is missing, that a lot of time when you go on workshops like this, people have questions, but not necessarily those speakers can answer them, because there is one speaker that maybe he's good in the tax department, or they are representing the law firm, or they may be a business consultant. So that is one of the reasons why we formed this, because like I realized early enough that people have questions, and if you go to seminars like this, most of the time you leave the seminar without your question answered. I also realized that people do not have a process when it comes to the business exit planning. Just listening what people were asking throughout those events, I realized that people don't have a process. How's the business exit planning how business exit planning should be done? What is the steps that you need to take? So fortunately, there is a Business Enterprise Institute from Colorado that actually certified people like myself in a business exit planning that helps with the process and procedures. So we do follow a 7-step process when it comes to the business exit planning. Step number 1 is the question, $1,000,000 question: when you want to get out of the business? How soon? And a lot of time I heard the answer like 5 years. So I asked them, okay, what is the date? What is the year? Because a lot of time they say 5 years, but then you ask them next year, they say 5 years. And 2 years from now, it's going to be 5 years. So we already 7 years in, and they still have a 5-year target. So it's very important that when you are thinking about getting out of the business, that you put actually definite goal time. So that's a step number 1. Step number 2 is we figuring out the valuation. What is the business worth? In the same time, while Ethan is going through the valuation of the business, we want to make sure that we do the personal valuation of your personal finances and make sure that you are actually put some money aside already. So we would like to see what is the financial gap between what you're going to get out of the sale of the business and what you accumulated so far. So if that gap and spread is larger, we need to work. We need more time to prepare so the business value can go up. Step number 3 is, once we figure out what the value is and there is a shortfall, we need to figure out what are the value drivers. How can we increase the value of this business? So value drivers is, what is the lines of business that you have? Can you increase it? Can you merge with another company? Can you buy a company while you're preparing for your own exit, just to make your balance sheet look better? Can you optimize your business and see where the money can be saved? How many times you actually do that? How often do you look at your P&L and look at all the expenses that you have throughout a year and it says, okay, where I can optimize my P&L? What is it that I can do, or maybe reshuffle so I can save some cost and increase the bottom line? Step number 4 and step number 5 is figuring out who you want to transfer. Is it going to be internal transfer to the family member, or a management team, or partner, or all of your employees? Or is it going to be a third-party sale? We usually have a rule of thumb: if the value of the business is over $5 million, probably you are a candidate for a third-party sale. Why? Because if you're selling internally to one of your partners, usually it's an earn-out, because partners or your employees do not have money to buy straightforward. So because it's an earn-out, it will take a long time, and you might not like that, because earn-out is dependent on your cash flow and your net cash every year. Step number 6, by far the most important step in any business planning or any business exit planning, is called continuity planning. continuity planning is creating a written document, and we help you do that, written document that will actually spell out what will happen if something happens. So it will cover all those if scenarios. Who will take over the clients, who will take over the relationship with the vendors, who will take over the relationship with the banks, who will inform your clients about you departing out of the business due to some sickness or illness, or worst case scenario, you died. So continuity planning is something most important, but I'll tell you, in my 14 years of experience and my 14 years career, I see 0 businesses with a written continuity plan. And the last step of the 7-step business exit planning is actually how is this going to be transferred within your family. It's called estate planning. How is this business transfer going to be a part of your overall estate? Will there be any taxes down the road because you gifted your business today to your kids? So it's kind of wrapping your hands around everything and seeing your exit plan, not after you exit, but 30 years from now, when you're gone and you're transferring to the next generation. So I'm going to go in a reverse a little bit and ask Scott about the continuity planning documents. And one of the documents that is a part of that is buy and sell agreements. So Scott, tell us a little bit about, from your experience, how common is this document and how often people actually spend time thinking about writing it and putting the right provisions in the buy and sell agreement?
Sure. So most small businesses start out as a handshake, maybe a couple of partners, and let's go into business and do something together. They might pull an LLC form off online and just file it, and you don't have to have an operating agreement in place. You can just file your articles of organization and get going. And you have a handshake and everything is hunky-dory. You're both working really hard just to make the business go, and you'll figure you'll work out the other stuff later. Some folks do have an operating agreement in place, and that kind of just says who owns what percentage and what generally the economic terms are. But most standard form operating agreements, unless you really dig in deep or go see an attorney about it, don't have what if scenarios covered. Like, what happens if somebody dies? What happens if somebody gets divorced? What happens if somebody wants to quit? What happens if somebody gets lazy and doesn't show up to work very often? All these scenarios, when you're kind of working together, what happens to the company? How will it continue to function? Have I set it up in a way that allows it to keep going? So that's what Marco's talking about. So what we try to do when we help set up a company, or you can always change your documents. We do for folks that haven't set it up but now are starting to think about it, is to create either a buy-sell agreement or something similar to that, which covers as many of these what ifs as we can. You can't cover them all, but you can cover a lot of them. Like, if I get disabled, if I die, if I divorce, does my partner want to be in business with my wife if I get divorced? Or how do I cover that issue and keep the business protected? So we create rights to buy the other person out, formulas for a buyout, or formulas for a push out or a cram down, or there's different ways to deal with it so that the business is protected. There's also, in the cases of like death or disability, you can buy an insurance product so that there's money there, Keyman Insurance or some kind of liability, a disability insurance that comes in to help the company stay afloat and move forward if somebody who's critical to the business is not able to continue to be there. So those are the types of things that we do in the document.
I will tell you that a lot of time the reason why people didn't write the buy and sell agreement on the beginning of their career is they didn't have money. And they were like concerned with the cost of the buy and sell agreement, legal documents cost. And unfortunately, a lot of time they happen up front in the beginning. They don't have money and they just get a templated version. And then what happen like 5 years, 10 years down the road, they get in some kind of little legal dispute with the partner. And that actually cost is now, instead of like $3,000 or $5,000, is like running in millions. So I don't know how many times we said that people should have a buy and sell agreements rewritten or revisited while you're still in a honeymoon phase with your partner. Unfortunately, we still see people have like templated versions or no buy and sell agreement at all. Especially if you get in some kind of pickle with a partner, valuation is very important. If you have a buy and sell agreement, most of the time we see the fair market value valuation. So Ethan, why don't you tell us like about a different type of business valuation that people can do and how they can determine the value of their business?
Yeah, and within the context of buy-sell agreements or buy-sell provisions, a lot of business owners don't realize that that agreement is their default exit plan, whether they like it or not. It dictates how things are gonna happen. Just some experiences. One that I'm working on right now. There's a partnership, and it's two brothers. They are no longer seeing eye to eye. One wants to get bought out, and they look at their it's a stock purchase agreement that governs what happens when one shareholder wants to buy the other one out, and it says that you need to try to agree on what that amount will be, and if you can't, then you've got to hire an independent business valuation professional, and then if you guys don't agree on that one, you've got to hire another one. They have to talk, and if they can't agree, you hire a third appraiser, and it gets really expensive. They're on the first phase right now, and have retained me to help them, and so unfortunately, the wording of the agreement with respect to valuation is also very important. In this particular case, it says that the value of the business can be determined using generally accepted valuation methods, but you cannot consider goodwill in the value of the business. So what's goodwill? Goodwill is this unidentifiable intangible asset. It can be your reputation, it can be customer relationships, it can be your brand recognition, things like that you can't put your hands on. And then there's also identifiable intangible assets, which would be licenses, trademarks, patents, and things of that nature, things that are documented. So in this case, it's interesting. It's an outdoor kind of guiding outfitter type operation, and there's important licenses that allow them to operate. And so we're going to have to value the business and then value those licenses, those intangible assets, but we're going to have to make sure that the goodwill is carved out. And it's going to be expensive because of that. So the wording of the document is very important. Yes?
Yeah, I had a question on your appraisal. Three types of buyers, say an ESOP, buy-sell, and it's a third-party individual or a company. Is there a difference in the appraisals, cost? Or would they be the same cost of the appraisal for all three?
Okay, so the question is, depending on the purpose of the valuation, whether it's ESOP or for a third party, is the cost different?
The same.
The same, yeah. So the answer is probably similar, but not the same. It just depends. Every evaluation is facts and circumstances specific, and just as in the case of this business, there's a lot of moving parts.
The buyer really has an influence in there.
Yeah, and it depends on the complexity, and as Scott mentioned, the quality of your information, your books and so forth.
So a lot of times people throughout the process of their career as a business owner, they try to minimize the taxes, right? Every year you're kind of like scrambling to minimize the taxes so you can minimize your profits so you can minimize your taxes in the same time. But unfortunately, like when it comes to the exit, that is the double-edged sword because that will lower the value of your business. So tax planning in the whole process of business exit planning is very important. So Charles, why don't you tell us a little bit about the tax planning that people should do regardless when and how they're going to exit the business and how they can incorporate that so the value of the business actually doesn't go down.
I don't know how to do that. By show of hands, how many of you are all of you are business owners, pretty much? Yeah, good. And you're most of you are C corps. Anybody C corp? Yeah. S corps. 1.5. Partnership. Yeah. Schedule C. Anybody just a Schedule C? Yeah. Okay, good. We know that as a Schedule C, depending on the amount of money you make and the income level, that's the most highly taxed, right? You pay income tax at the Fed and state level. You pay self-employment tax on the first $125, almost $130,000. So as a Schedule C, you're paying the most amount of tax. So we know that there is some efficiency north of $50,000 of taxable income where you might look to change your legal structure. You might need to have an LLC or put in place, and then you want to flip to something. Good news for you C Corp owners, right? 21%. Gotta love Trump.
Yeah.
Right? You don't have to love him, but you gotta like 21%.
Waiting to feel the impact.
Yeah.
Just waiting.
Good. Well, okay, good. Yep, we'll make some money. We'll save some money because it gone down, right, by almost a third, right? Top rate was 35% down to 21 for you C Corp people, so that's good. On the individual side, just to create some parity for all of us business owners that have pass-through entities, either a Schedule C, a partnership, or an S Corp. Now for 2018, you can exclude up to 20% of that income from tax. That's a new code section. 199 Cap A is a new code section that says to the extent that you have a pass-through entity and you're a business owner, you're going to exclude for federal taxes 20% of that income. Except if you are a specified service business. So if you're an attorney, an accountant, a financial advisor, a business evaluator, if you're a doctor or any other profession where the income is based on the skill reputation of one or more key people, you are not in that rule. You're out.
Did you say that applies to LLCs too, as it passes through?
Yes,
You
it's
can
for all
add
pass-through.
20% off? Less?
Yes,
And
yes.
this would be based on your year-end valuation, your net.
Your net
net-
profit, your K1
net
amount.
income. Yeah, K1.
Yes, if you're in the slot and you're not a service business, a specified service business, you can exclude 20% of your income. No federal tax. State did not adopt that rule. They specifically are not adopting that code section. On the Fed side, you are. There are some other rules related to that. In order to get the 20%, you're limited to 20% of the K1 or 50% of the salary from that business. So if
That
you-
is the catch. There is a catch.
So,
Say
yeah.
that, I'm sorry, say
Sure,
that again.
sure. Two things, and I'll blanket it this way. 199 Cap A. Take that back to your CPA. You've got 26 days, 25 days to act on it. This is huge. If your CPA hasn't talked to you about it yet, call them. We'll break for 5 minutes. Call them now. Because it's not that simple. Yeah, look, I just put it on his hand. Yeah, it's super good, but you got to get in the slot. So Mark and I were just meeting with a client. He's got $1.2 million coming out of one business. He's got $1.5 million coming out of the business. And he's got a small loss in the other. Super good. Not a service business, so he's going to get it or not. One business is a product business, no payroll. Super good. So we're trying to figure out, can we consolidate the 3 businesses, use the payroll from the other 2 companies, right? $1.2 million, 20% is $240. He's going to save $120 in taxes. But under traditional rules, he's got to have enough payroll to get it. We're trying to look at the rules, and the IRS has come out with some guidance. Can you consolidate the payroll in the other companies? So 199 Cap A, super good, but you gotta meet all the qualifications.
Just to make clear, the payroll is for the business owner payroll, not for the.
It can be certain others, but
Yeah.
talk to your CPA about it. But so there's time, but you gotta get to it, right?
Thank you.
Okay, sure, thank you.
So business planning, again, very important
Yeah.
part of the exit planning, making sure that you're showing the value of the business in the same time you're minimizing the taxes. So
Mark, can I
I
add?
think that's something that we kind of like battle like all the time, so go ahead.
No, I think that's right. So what do we do as business owners? We put everything in there, right? My car's in there, my wife's car is in there, my cell phone for myself and my wife. We're just cramming in there why we want to get the tax section, so get it down real low. Right? When you get to the business valuations, well, we're not going to have that, we're not going to have that, we're not going to have that. You want to elevate it back up, so, you know, maybe you can share on that.
Yeah, so part of the valuation process is that while these totally legitimate tax deductions are there,
Thank you for that. And we're being recorded.
we, as valuations, we put on our valuation goggles and we see through that and we look at it from the eyes of an investor, and we need to present the company's financials on an economic basis. So it's the basis from which an investor would want to see the business, and they're going to want to see what cash flow would be available to me if I invested in this business at the end of the day, after everything's paid for and all the provisions are made so that the business can continue. And so that's the way we look at the business. So start with the tax returns, we end up with normalized financial statements.
So that's cool. To Marco's, your question, how do you get to the both, that's